as markets reprice the outlook for Fed rate cuts this year. Our next guest flagging the fact that the higher yield could be a potential headwind. Let's bring in Keith Lerner. He's Chief Market Strategist at Truist for more. Keith, it's great to see you here. So let's talk about the level that we're at right now. So we're right above 4.2. At this level, is it a bit challenging, or is it when we push up against 4 or 5? What does it look like?
Yeah. Well, first, great to be with you in Madison. Regarding the 10-year, so I think we need some context before we say how much trouble this is going to be, because we've been up 10 out of 11 months and we're coming off a 6-week winning streak. So I think with that and sentiment getting a little bit hot, that a rise in 10-year does provide a little bit of a challenge. But what I'm encouraged by somewhat here is that when I look beneath the surface and I look at what's called credit spreads, so are we seeing something systemic? We're seeing credit spreads near the lows. So that's telling me that this is the yields are moving higher because investors are feeling more comfortable with economic growth, and at the same time, that's peering back on how aggressive the Fed will be. So I don't know the exact magical level. I think from here to maybe 450 will be a challenge, but I think it's also because the market's at a spot that has moved a long way in a short period of time, and this is an excuse for the market to at least digest and maybe trading a little bit of a choppier fashion, in addition to the election now about 2 weeks away.
Yeah, and that election coinciding with the early month macro data we're going to be getting, what do you think is going to drive the market more heading into the start of November?
Depends on which day you ask me. I mean, on the day of the election, it'll be all about the all about the election. I mean, that employment report comes out a little bit before, but what I'm seeing, I've just been on the road here recently. I mean, the focus is really centered on the election. So I think the employment data will matter, but the first getting over the hump on the election, I think is really going to help investors kind of get a better idea of the landscape, even though it will be likely a choppier period. We don't know if we're going to know the results that day, and if there will be any contested election, all of the stuff that we don't know. But I think that's going to be the biggest impact, because that's all people are talking about right now.
Keith, what do investors need to prepare for in terms of what that activity is going to look like around the election?
Well, it's interesting, because this year, I will say, we're not really following the historical script that closely. The first thing to be aware of is this is the strongest year for the S&P 500 in any election year, at least since the 1950s. What tends to happen, though, is you tend to have a little bit of a buildup of anxiety as you get closer. I almost feel like people have signed, even though there's been a lot of rhetoric, I think some investors have almost ignored some of this focus on things. And when it comes, I think we will actually have a deep focus. But you tend to have a little bit of a spike in volatility heading into the election. And once you get clarity, then the market tends to have a sigh of relief. And in an election year, the final 2 months of the year, you've averaged a gain of about 3%. So, again, keep that in mind in a historical context. But I think after we get through the election, markets will then refocus back on the fundamentals and, the Fed and the economy and everything else.
Well, one of the other fundamentals of our economy right now feels like NVIDIA. Torsten's log out with a chart this morning talking about how NVIDIA has a bigger market cap than 5 of the 7 G7 countries. Retirement accounts, index funds, all over indexed to this one tech name. Can we continue to be a bull market that's relying so heavily on NVIDIA?
Well, if you look overall, I mean, you still have over 70% of stocks in the S&P in long-term uptrends. So NVIDIA has been a big part of the market this year, but we also have to realize up until this recent breakout, which is only a marginal breakout, it's really moved sideways since July. And what you saw other areas of the market, do fine, and the market moved to an all-time high, even though NVIDIA was trading sideways. But I do think it is a bellwether for semiconductors and technology. Technology is about 30% of the overall S&P. So it is important that tech participates. We still like tech. We upgraded our view of tech on the pullback in August. And I still think, the theme of this bull market is still AI. If you believe the bull market is intact, which we do, I think you have to still believe that there's still further to go on the AI side. So it likely has to participate. But again, look at the financials, making an all-time high as well. And up until today, industrials were doing better. Utilities, even though these rates are moving higher, another area where overweight, also doing relatively well.
All right, Keith, we got to leave it there. Really appreciate you joining us. Thanks so much.